Comstock channel. My name is Brian Hendrickson. Today I have Dan with us. Welcome.
It's always good to be here.
Glad to have you on. We are not talking WASD report, so you don't need your wizard hat. But I am still going to have you crunch some numbers for us in a way. We're going to talk about seasonality. Yeah. First, I want you to just tell us about that, but also how it can help the farmers.
Well, seasonality is just the tendency over time, no matter what the various price levels you're talking about. Seasonality is the tendency for the stronger prices of the year to happen during certain times of the year, and the weakest prices of the year to happen during certain times of the year. Now, the supply and demand fundamentals determine what price levels you're actually talking about. So we're just talking about how to let the history of seasonality guide your post-harvest selling out of the bin or out of storage.
All right, so let's go ahead. I'm going to have you dive in because I'm going to let you take the reins on this completely.
All right. Here we have a corn future seasonality, and I first have to explain exactly what are we looking at. These are 20-year average prices that begin in January and go through December. And that's a 20-year average prices through December of 23. So it's the most recent 20 years. And the numbers, you say, well, there's no prices on the left-hand scale. There's just percentages. What are those? Well, that's the percentage of the price level where it began in January. And so that's why I said the price levels, specific price levels or price range we're talking about doesn't matter. We're just talking about seasonality. Where are the peaks and valleys in the corn seasonal chart? And so I've got some circles to mark certain spots on the chart. So I want to draw attention first to the far left-hand circle, that first red circle in about early March. Now, it's obviously a peak. And so what that says is that over the last 20 years, the average corn price has been about a little over 6% higher than where it began in January. Again, January is the starting point. Where were prices in January? But I got to back up a little bit because the marketing year, of course, starts September 1st. So one logical question might be, well, where is that January price relative to where they were at harvest? And over the last 20 years, the average has been about a 6% gain from harvest time, say October, to January. So that part doesn't show on the chart. But it's important for people taking notes, it's important to note that the harvest price is usually about 6% below the January 1 price. Now, we have this seasonal rally, a tendency to rally into about the 1st of March. And why is that? Well, it's you're getting rid of, you have to have some price risk built in because of the South American crop and the fact that most farmers sell a good deal of what they plan to sell at harvest. In fact, you wonder, what's the average farmer hanging on to January 1st? The average farmer is still holding on to about 60% of his crop or her crop at the beginning of January. But there's a lot of variation in there. You will have a whole bunch of farmers that sell most of the crop right out of the field because they don't have storage, and storage is expensive. And you have others who are fairly well heeled in terms of cash flow. They just can't stand these current cheap prices. And there will be some farmers still sitting on almost the whole crop come 1st of January. But the average is about to have about 40% sold and hanging on to so that's our starting point. We're assuming a producer starting out in January with about 60% of his crop in storage. And that run up into the 1st of March has to do with weather risk in South America, the unknowns. And of course, this year we're dealing with a crop that started out really poor in South America. And then just in recent weeks, as the rains have come, it's gotten better and better. But then what accounts for that drop off? There's a seasonal tendency for it to drop through the month of March. And there's a couple of reasons for that. One of the reasons is that it takes away weather risk premium because by the 1st of March, we pretty much know what kind of crop the Brazilians are going to have. And secondly, you got those 1st of March land payments or lease payments that come up. There's always there's a cash flow need that happens around the 1st of March. And believe it or not, those are the two big drivers for that seasonal break that we get. So what does this tell a producer? It says that if I know I have to sell something for cash flow reasons by March 1st or March 15th, seasonality suggests that about the end of February, you ought to at least make those sales. Because hanging on to the crop to the last minute, okay, it's the 15th of March, I need to write a check, so let's sell some now. You've probably already missed some of the price rallies. So that's how this helps. Whatever you got to sell for cash flow reasons in early spring, you might want to think about having that sold. Now, if you're still bullish on the futures market, you have to ask yourself, what are the continued reasons to store grain? Well, there's only two reasons to keep grain in the bin. One is the expectation of price appreciation on the board, and the other one is basis gain, the expectation that the base is going to get better between now and then. So you look at where basis is, you look at carry in the futures market. Right now, for example, we do have a premium structure where the out months are higher than the spot month, but it's not that much. There's about maybe a 5% carry from March to July corn, and there's only about a 3% carry in beans from March beans to July beans. So there's not much. There's some carry, but not much carry in the market. So moving on then we get a break. Now, before I go into that break into the end of March, I want to talk about the extremes. Remember, these are averages over a 20-year average. What are the extremes of that January, February rally? There have been some years in the last 20 years where that rally has been as much as 20% higher than the 1st of January price. And those are years where there's a horrible crop outlook for South America. The crop estimates are dropping, day by day, week by week. So there have been some years where that early March peak has been as high as 20%. Now, how about that dip through the month of March? This shows that on average, that dip is about 4%. So that prices they're down, but they're still 4% higher than they were in January. But there have been some years where the extreme has been 6% under the January price. So for those people taking notes, that January, February rally, there have been peaks of as much as 20% above January. And there's also been years where the market has just collapsed to only to 6% below the January price. So it's a wide range there. Now, moving on to that black circle, second from the left. Okay, that's at the end of April, beginning of May. Why do prices tend to peak right there? A big part of it is because now we have the planting intentions. We know what the acreage mix is going to be. So there's an element of market risk that gets pulled out of the market. That's the risk of not knowing what the acreage is going to be. Well, at the end of March, you get a planting intentions report. So whatever that is pretty well known. And also, by the end of April, you have a pretty good handle on what the May weather outlook is. Is there going to rapid planting? Are we going to get the crops planted on time? So that's why we tend to have an end of April peak. Now, this shows that on average, about 8% over the January price. But there have been some years within the last 20 where that peak has been 18% above the January price. But then again, there's also been a year where the extreme low was 15%. That mid-May dip, that low was 15% below the January price. So there's great big wide ranges in seasonality. And what that tells us is that if you're looking at current prices, where they are relative to where they were in January, this seasonal history here can give you at least a gauge as well. Is that a good price relative to January or a lousy price relative to January? Now move on over to the green circle. Okay, that's where you usually get your peak of weather uncertainty. Why is that the peak of weather uncertainty? Well, you're starting to get, first of all, you'll get your January planning report. Now it's not just intentions. Now we've already seen what the actual planted acreage was. So that element of risk of not knowing what the acreage planted was is gone. And that has to be taken out of the market. And since that tends to be a peak, all this tells you is that more years than not, once you know what the acreage is, the market is going to assume average weather or better than average weather. It's going to assume that unless it has reason reasons to think otherwise from long-term forecasts. So that rally there, that mid-June rally, on the average over the last 20 years, about 9%. But you know what? There have been a couple of years where that rally has been major bull market years related to South America and lousy weather in our country, where that rally has been as high as 35% over the January price. Now, they were, I can't tell you which years those were without looking them up, but that's the range that you're dealing with. Then you just get into a kind of a sideways pattern in July. That next red circle after the green circle, that chops around sideways. Now, remember, these are 20-year average prices. And that's because you have an element of uncertainty over the weather that usually favors a good crop outlook. More years than not, we have average weather or better than average weather. And so that break it oscillates between maybe 4.2% over the January price to 6% over the average price. But then there's a sharp fall off, a strong tendency, seasonal tendency for prices to drop after mid-July. And I've been doing this for a very long time. And a big reason for that is by mid-July, you now have the 30 and 60-day forecasts for July and August, and they're out. And typically, whatever happened, this is an old rule of thumb. The first trading day after the 4th of July weekend, if that first trading day after that long 4th of weekend, if it's lower, chances are that's what's going to be the trend through the end of the month. And that's because that's when those long-term forecasts come out. It's kind of you might say, an old wives' tale in the trade, or an axiom. Watch what the trade is the first trading day after the 4th of July. Now, let's go down to the fall lows. It's no secret to anybody. Lowest prices of the year tend to come in the fall. What may surprise people is that the harvest low seasonally for corn actually comes very early in October. Logic would suggest, well, the low must come when almost all the crop is harvested. But remember, these are futures seasonality charts. And it could well be that because of basis deterioration, the low in the cash market comes later in the month of October. But futures anticipates the low. And that's why this futures chart shows that the harvest low often comes very early in October. As we move on then into the rally that follows, the classic post-harvest rally, takes us back to about 2% over the price from the preceding January. And then you get a dip into November, and that's the tail end of harvest where more harvest pressure comes in. Whatever doesn't fit in the bin gets sold, basically. And then you get your post-harvest rally from November on forward. So again, the way to use these charts is that if you know you're going to sell a certain portion of your crop by the calendar and not just by price targets, these help guide you into knowing how not to overplay your hand on a seasonal basis. And you want to get, if you know you're going to sell some before planting season starts in late April, for example, you want to get that stuff sold before the month of May begins. Similarly, in June, if you know you're going to have to sell some more crop in June, this chart says that by mid-June, you probably ought to make that sale. And if you're still bullish on prices, you can buy a call option to replace it. But just from a seasonal basis, you're fighting history not to follow these rules.
How significant is the role of all of this historical variance in guiding pricing decision?
Mostly it guides the cash market decision over the futures market decision because it's mostly about basis. What this suggests is that these are guides to watch out for basis deterioration, you might say. So you might separate the decision, say, I've probably got all the basis gain I'm going to get. So I'm going to make the sale now because I need the cash. And if I'm still bullish on the board, I'll either, when do you buy bullet? Do you buy futures or do you buy options? The answer I always have for that is if the trend is already up and you're pretty sure it's going to stay up, but you need cash, then just replace the cash sale with a purchase on the futures. However, it's kind of choppy and uncertain, and you're pretty sure the market's going to go up eventually, but not sure when. Then when you make your cash sale, it's better just to buy a call option because that gives you the staying power. The saddest stories that we hear in this business are people who bought calls and got stopped out 2 or 3 times at losses. And then when the market finally made the move, they weren't in the market because they'd been stopped out several times and probably at losses exceeding what the cost of the option would have been to begin with. Here we have a kind of a similar pattern. We have, again, this is a 20-year, these are 20 years of the average price relative to where it started the year in January. And similarly on corn, where I says, okay, well, what about the harvest? The harvest time soybean price was about 5% lower than the January price showed right here. So there's on average about 5% improvement from harvest to January in soybeans. Now, moving forward, you get that January rally, and this shows that over a 20-year average, that rally has been up to about 5% higher, say 5.7% higher at the peak than the January price. But again, within that 20-year period, that's a 20-year average. Within that 20-year period, there were extremes where that late February peak was as high as 18% over the January price. And then you get that break into the middle of March, and this shows that that break would take prices down to maybe, say, only about 4% over the January price. But there have been years within those 20 years where that break was to 10% lower than the January price. So that's the range we're talking. This is the 20-year averages. Moving on to the black circle that comes next at the end of April. Again, now you've got the March planting intentions are out. You pretty much know how big the South American crop is, so a certain amount of weather risk has to be taken out because it's no longer an unknown. There's still some unknowns about our crop, but the unknowns about South America are no longer present. So this shows that on average, that late April rally takes us to about 7% over the January price. The extreme has been 10% over the January price. Then go over to the next circle, the extreme peak in June. That's where after we have the June acreage report, so we know what the acreage mix is going to be, that element of weather risk has to be taken out of the market. On the acreage, not weather risk, but acreage risk has to be taken out. And so this shows that on average, that June peak is about 9% over the January price. So again, the producer looks at where current prices are relative to where they were in January. And if they're about 9% higher than January, seasonality suggests, well, on average, that's about all you get. But there have been extremes. There have been extremes over the last 20 years, Brienne, where that June rally in soybeans was 20% above the January price. Then you get the big break into the end of June, the choppy sideways action between June and July. And this shows that even when you get that break, the price is still about 4%, anywhere from 4 to 5% over the January price. There have been some years where that has dropped to 5% below the January price. So there's a wide range of risk there as well. Moving on forward to the harvest lows. Again, on the board, you normally think, well, harvest lows come about mid-October, but on the board, just like in corn, they come early because the nature of the futures market is to anticipate lows like that. And on average, the harvest low is about 4% below where prices were in January. But there have been some extremes there as well. In fact, there have been a year or two. Well, the actual extreme was 24%. There was at least 1 year in the last 20 years where that early October price was 24% lower than what the price was in January. Then you go up into November, some choppy sideways movement in through the month of November as we're finishing up harvest, getting some harvest selling pressure on stuff that won't fit in the bin. And the range on that shows anywhere from par with January to maybe up 1.5%. That's the average. But the range even for that period in November has been from 5% above the January price to 15% below the January price. So even that black circle over November there has a lot of variation. These are 20-year averages. But this is guidance that we would suggest for timing your cash sales. When you know you're going to sell some and you're selling in different times of the year, you want to try to time the cash sales with the seasonal highs. And if the outlook is bearish, then just make the cash sale and be done with it. If you're still bullish, then consider whether you really think basis appreciation is going to pay for continued storage. History suggests it won't. And you have that choice again. If you want to replace the cash sale with a futures position, if the trend is up and you have every reason to believe from what you're reading that it's going to continue higher, then just replace it with a long position on the board. But if you're pretty sure it's going to go up eventually, but you don't want to get stopped out if you're wrong on your timing, then just do the option instead for the same reasons that I explained earlier for corn.
So looking at between corn and soybean, like you said, this is a 20-year average.
Yeah.
What recommendations would you provide for those looking to incorporate this seasonality and historical variance analysis into their overall market analysis and pricing strategy?
The best answer that I can give that is that these charts are relatively static. In other words, it's a 20-year average. At the end of this next year, if we throw off the year that's now 21 years back and add the new one, it's very unlikely it's going to change the seasonality very much. So this is not a chart that changes drastically from year to year. And so this is a keeper chart. It's, in my experience, there's only been any significant variation in the seasonality of prices, maybe over a 5-year period or a 10-year period. And usually it's that, even that variation is only caused because you had a freaky drought year that sort of distorted the basis or distorted futures for that season. For the most part, this is a good keeper type of chart.
All right, that'll do it for this episode. Thanks so much.
You're welcome.
You can find us on Facebook, YouTube, and TikTok.